You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO This Week in Futures Options. The program and the name pretty much says it all. We're going to break down the week that was, and indeed still is, on the futures options side of these crazy markets we're all experiencing together. What's going to light it up? What's going to make it on our tape? Is it going to be, I don't know, gold, nat gas, 30-year, lean hogs? You got to tune in every week to find out. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you are just sucking it down with 10 straws these days. Go ahead. There's more where that came from out there. If you like what you hear, this show, anything else on the network, throw a rating, a star, a like, a comment, whatever your platform lets you do. All of that in aggregate does help new people continue to discover the content. And of course, if you want to discover more content in your lives, then we have those great pro Q&As going on, Options Oddities at the end of the week, live streams for this, everything else we do. Had some great double headers this week, double header of Options Bootcamp for our pro folks, as well as, of course, double pro Q&A sessions. On Tuesday, we had our buddy Mr. Rich Excel in there recently. He's been on the show many times, tackling a lot of your questions across all of the asset classes out there. That guy goes deep, so all sorts of fascinating stuff. If you have questions about futures options or anything else, volatility, crypto derivatives, general, plain vanilla, Apple and SPY options, it's all there for you. TheOptionsInsider.com/pro, the place to go to learn more. As we go to learn who's joining us on the old CME Group hot seat today, I'm pleased to welcome back to TWIFO. It's been a little while since we chatted with him on this show, since late September, with our old buddy, the once future and now present Dr. Vix, Mr. Russell Rhoads, now moonlighting over there at the Kelley School of Business, corrupting future minds in the financial markets. Mr. Rhoads, welcome back to TWIFO, sir.
I try my best to corrupt as many people as possible every day of the week. And being a college professor offers ample opportunity to do such things.
That it does indeed. Let's see how many people we can corrupt with the show, because it is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, a portion of the show where we break down everything lighting it up to the light side and to the dark side over there at CME Group this week. Mr. Rhoads coming off a hot and heavy week, another Fed week, our final Fed week of the year. So a lot of action, as you might estimate out there. What's catching your eye? What direction should we start our show with this week? To the light side or to the dark side, sir?
What do we want to do? Well, God, it's so mixed. Let's get the light side out of the way.
All right, there's a lot of light side to be found.
And one light side is like my victory lap.
Oh, well, we shall get there.
Finally.
Then. We shall get there. To the light side we go. Listen, by the way, if you want to see this chart for yourselves, you can follow us at Options on Twitter. Follow CME on Twitter as well. You'd see that it is pretty heavily green. Our buddy Mr. Powell and company saw to that yesterday with their extremely dovish sentiment out there. So we could put together a bottom 5 and indeed probably a bottom 10. Beyond that, kind of pushing it. So to the light side we go. Number 5, kicking things off in energy. It is RBOB up 6.53%. You know it's a banger week where you have to be at least 6.5% to make it into the top 5. That's a lot of movement, listeners. Number 4, the E-mini S&P Mid-Cap 400 up nearly 7%, 6.7%. Number 3, the real estate sector of the S&P, so a lot of equities on the show this week, up 7.09%. Number 2, Mr. Russell's namesake, the Russell 2000, up nearly 8%, 7.97%. Small caps just on the rampage, listeners. They're popping again today, another 2.25%. They're up 2.5% earlier, so just madness out there. And then what could eclipse all of that? So we had energy, and then we have pretty much all equities. It's palladium, listeners. Number 1 to the light side this week, up 14.04%. Also takes the winner, just slightly, takes the winner of our largest percentage mover on the week as well. Now to the dark side we go. Like I said, not a ton of dark side, but our top dark side is a bit of a banger. Number 5, we're back to the ags. It is soybean meal off 2.7%. Number 4, it's soybean oil off 2.81%. Number 3, Chicago wheat, I'm catching a theme here, hanging out in the ags still, off 4.63%. Number 2, keeping it in the ags, it is KC wheat, off 5.21%. Again, you're picking up a theme here, listeners. Not a good week for the ags. By the way, Chicago wheat was number 2 in the other direction last week, up 7.44%. And KC wheat, number 4 in the other direction last week, up nearly 4%. And then our number 1 dark side mover, almost as large from a percentage perspective as our number 1 light side mover this week. It is nat gas off 13.66%. Man, they hate it this week. It was number 4 in the same direction last week, off 7.2%. So that puts us off over 20% just in the past couple of weeks. So a rough couple of weeks out here for nat gas. Kind of mix on the energy front, which is interesting. Nat gas to the dark side, RBOB to the light side. Then a whole bunch of equities in the light side. Got some metals and a whole bunch of ags to the dark side. So Mr. Rhoads, we have a lot of potential starting points this week. We could start in energy. We could start in equities. Or we could take a journey to the dark side of ags. So what's floating your boat? Where should we start this week, sir?
Let's start with ags. I want to do energy, but you already know that there's a lot I want to say about energy, so I don't want to I don't want to get hung up on that, and all of a sudden we look up and 45 minutes have passed.
All right, then.
So
to the ags we go, listeners.
It's time to get our hands dirty exploring the latest options trades and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, listeners, you know where to go to find the ags and just about everything else we're going to talk about on the show today. CMEgroup.com, then go to /TWIFO, This Week in Futures Options, /TWIO, This Week in Options should also get you there. That'll get you to our reports for this show. Now, they're live throughout the week, not just during the show, but they are a great resource, a great reference. You should be following along with those while you're listening to the show. And again, check them out whenever you want. They're running all week long just because we like you folks. And there's a lot of ags in our dark side movers and shakers this week. I think we're going to go to Chicago wheat first. It is one of the more active of those products out there. 106,000 contracts on the tape right now for good old SRW wheat, aka Chicago wheat. KC wheat I know is higher, listeners, but a much lower volume product. So we're going to hang out in Chicago wheat. Not a huge difference, 0.6% between them right now. Where is Chicago wheat hanging out? 616.5 in that front future, listeners, off about 15.25 or nearly 2.5% just since Monday. Of course, you extend that back to the end of our show last week, it's off 4.63%. So a rough week out here for ye old Chicago wheat. In terms of vol, for those of you who don't keep your finger on the pulse of all things ags, the vol right now in Chicago wheat, about a 29 even, off about 3.7 points. So ags coming off. The ags have been a decent, I would call them a decent repository for volatility lately, at a point where vol is coming a little bit harder to come by. You know, you have your energy and your nat gas really that are known to be bastions. Crypto is starting to creep up there again. We all know what's going on with equity vol. That's going to die. So if you're looking for vol right now, the ags, you could definitely do worse. A 29, again, you're talking more than 2x where VIX is trading right now. So that's nothing to sneeze at. Again, off about 3.7 points on the week. In terms of action this week, again, 106,000 contracts on the tape, 45% of that paper going up in the Jan contract that has about 8 days to go. So, Mr. Rhoads, we got a little bit of an almost a weekly Chicago wheat palooza. Everyone's talking 0 day and near dated in the equities and some of the other products. No one's talking about it in the ags. Maybe we have a new story to talk about. I know you're not a huge ag head, Mr. Rhoads, but anything catching your eye out there, sir?
No, so I was kind of looking at the term structure and some of the different products, and I didn't see anything that makes me think anybody's got any huge conviction in either direction right now. I know that's not very helpful. So I know, and I'm having trouble getting the TWIFO site up. That's really just to be total full disclosure here. Yes, I did choose ags. And then I couldn't get the TWIFO site to work. So I don't have the data to refer to right now. Still, while I register for the CME site so I can get a TWIFO.
That is weird. Maybe you're behind some weird paywall because I am not logged into anything and I'm looking at all this stuff.
When I went to do it, it just says
maybe they hate you at University of Indiana or something.
I wouldn't be the least bit surprised.
Either way, listener, let's get out into the fun while Mr. Rhoads figures out his internet connectivity over there. Let's go out to the Jan contract. Again, 8 days to go, listeners. The vol out here, a little bit higher, 31.75, off about 0.75 of a point. Skew-wise, last week the puts were modestly offered, 2.1% cheap. This week getting a little bit cheaper, 3.9% cheap. The calls last week, 3.5% bid. This week, 4.7% bid. So as a good ag is wont to do, sometimes you got a little bit of a bid to the calls, a little bit of a discount to the puts. We've talked about it before in other products like soybeans and others. These are the kinds of setups that make it favorable for things like collars. I mean, this one is not explosive, so I wouldn't be racing to go put those on right now, but it's certainly better than your, let's say, traditional equity, which is usually the inverse from a skew perspective. In terms of action, we've got the par puts, the 600 puts going up this week 5,500 times. That is our big dog out there in the world of Chicago wheat, listeners. In terms of action, the big day was yesterday. Who knew? Fed Day, a big driver for Chicago wheat as well. 2,100 contracts going up yesterday. Mostly opening 1,100 on Tuesday, slightly closing there. 18, almost 1,900 on Monday, slightly closing there. And it was just a few hundred today against OI of about 2,300 coming into today. So again, a total of 5,500 going up on the week. Behind that, we do have some put action and some call action, kind of tying. But actually, we have to go out a little bit farther, looks like, to get the actual number 2. We have to go out to March, the March 700. So par is in the other direction, going up 3,633 times this week. So interesting, a tale of two tapes, the near-dated 600 puts and a little bit longer-term 700 calls. Again, the big day for these, Tuesday, 1,700 going up on Tuesday, mostly opening. 800 and change Monday and Wednesday, closing both days. Today, just a couple of hundred, but OI coming into today, over 5,000. So decent amount of OI on the strike. So par puts in terms of 600 puts going away in 8 days, and the 700 calls going away. Again, these are the March listeners. They have about 71 days. Those going out a little bit longer term. That's what's leading your tape out there in Chicago wheat. Mr. Rhoads, were you able to suss
No,
anything
I'm doing my Duo push notification right now as I register for the site.
All right, well, you get all that sorted out. I think we got nat gas lighting it up to the dark side. I was kind of surprised. I thought you were going to choose energy first, but we have nat gas lighting it up. I know you got some energy lighting up your back pocket as well, so I think we'll head out there next.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, you know where to go to find the energy. Everybody except Russell, go into that drop down, and you're going to scroll down 3 slots, or actually 2 slots from ag, 3 slots total on the list, down to energy in the asset class. And then we'll kick things off in nat gas. And I have a feeling we might be making a pit stop over there in crude oil as well. Nat gas, our number 1 dark side mover this week, listeners. So all of you out there who are looking at maybe a 3-handle buying some upside in nat gas, not your week out there, off nearly 14% this week. And again, going back a couple of weeks, off over 20%. Nat gas, that front future right now trading $2.39. Off another 18 cents this week, or about 7.13% just since Monday. Of course, you go back to our show last week, off nearly 14%. So we had Mr. Rhoads' buddy Carly on the show not too long ago. She was talking about not exactly feeling the upside in nat gas of late, and certainly that seems to be the way the market is trending as well. Do we have another banger week out here in terms of volume? The answer is a resounding yes. Nat gas maybe moving into a new volume regime. It used to be 400 was a decent week, 450, pretty banger week. This week, 681,000 contracts on the tape, and that's been a number of weeks now. We've seen north of 600,000 coming into the show, so a lot of action going on out there in the world of nat gas. Go figure, as it gets cheaper, usually the options use case diminishes, but it's getting stronger, it seems like, out there in nat gas land. And again, of that paper, 32% going up in the Jan contract. It has about 12 days to go. So getting into the weekly realm there as well. Looks like the vol in nat gas. Nat gas, kind of our go-to product for volatility these days. 61.5, off about half a point. So kind of treading water from a vol perspective this week. In terms of skew, puts 1% cheap last week. This week, 3.6% cheap. So interesting. No one really wanted the puts last week, and that was clearly the play. This week, the puts getting cheaper. The calls, 2.2% rich last week. This week, 5.9% bid. So we had a modest, really kind of flat put skew last week and a slight bid to the calls. So that would maybe show you we were looking at some equilibrium to slight upside bias. This week, it is even more pronounced. The puts getting cheaper, the calls getting more bid. So that's kind of interesting. So let's see if the option skew can be wrong 2 weeks in a row, listeners. Is this portend another aggressive downside move? Or are we going to maybe find some equilibrium here, or maybe even turn to the light side? Mr. Rhoads, I know you love yourself some nat gas. I tried to buy you a little time to get your stuff sorted out. Anything catching your eye in the world of nat gas this week, sir?
I find it funny that the option market has completely gotten it wrong. And there's a whole lot of activity around the 4 calls when you go farther and farther and farther out, which makes me wonder if people are playing it for some sort of rebound. Did Carly opine on any fundamental reason this was going to happen? Is it that we had the breakdown in natural gas, or
she was saying she thought maybe it was a little overextended to the upside. She thought the near-term play, the near-term trend was to the downside.
Well, and if you look at, the freaking trend is, one of my students asked me about it a couple of weeks ago when it was hovering around 3, asking if that was a good level to buy it. And first off, I said, you deliver food for a Jimmy John's. You should not be trading natural gas.
I was going to say, I love that your students are slinging nat gas. That's great.
Oh, yeah. Oh, you wouldn't believe. So I almost feel like we should start a new show where I bring some of my students on, and they tell you what they've been trying to trade.
We can have our version of Kids Say the Craziest Things, but instead of about nat gas futures and options.
So no, he asked me around 3, and I'm looking at the January natural gas chart, and everybody thinks, and this is one of the things I try to teach undergrads. Everybody thinks The way to make money in the markets is to buy low and sell high. And in reality, the way to make money in the markets is to sell low and buy back lower. And this now, if there are any trend followers out there, they are that follow the rules religiously. They're having a great fourth quarter because natural gas broke down around. It broke support at 350, making a new low, and hasn't looked back. Now we're down around 240. It's just absolutely unbelievable what a textbook, it's just a textbook trend following pattern here. And, maybe, I do see where we bounced off of some significant moving averages, and that might have been what my Vegas buddy Carly was looking at. But man, the second we broke, we never even retested that 350 level. And my assumption is that the people that are buying calls on the way down are not adherents to trend following, and they've never heard of turtle traders.
They're off there delivering for DoorDash and clearly slinging some nat gas on the side. I love it. A new audience for the show, the Grubhub and DoorDash deliverers of the world out there who, when they're in their downtime, slinging a little bit of nat gas. Is that you, listeners? Are you taking a break from your deliveries to listen to TWIFO before you sling some nat gas? I'm curious. Hit us up. Let us know. Let's see what's going on out here, listeners. Again, it's been a wild week to the downside. One of the few weeks, as we alluded to, where the options skew seemed to kind of get it wrong, even though, again, it wasn't strongly biased in either direction last week. It was kind of more one of those shrug your shoulder types of weeks. When you see that, you usually take the skew with a little bit of a grain of salt. In terms of what's lighting it up out here, now that we're blowing through the 2.5 strike and threatening the 2 strike, no surprise that it will be the 2 puts going out in January in about 12 days that are leading the dance this week with about 21,000 contracts. Also worth noting, it's an action-packed week, but that's one of the lighter number ones we've seen in nat gas options at some time. Usually we're well north of 30+ thousand to take the number one spot in nat gas. This week, obviously, the paper kind of scattered all over the place. 21,800 is going to be enough to do it. That gets you to the 2 puts. The big day for these was Monday, 8,300 on Monday opening there. 5,700 today, 4,000 on Tuesday. 3,600 on Wednesday. Looks like back and forth opening to closing throughout the week. Today's paper is against OI of 13,400. So anyone's guess what they were up to today, probably given what we've seen out this week, probably opening. But again, we don't know. Then right behind it, though, if you think it's all downside all the time, there is some action on the 3 calls, again going out in 12 days. Can we get back to the 3 strike in 12 days? Listen, nat gas has been known to explode. That'd be a pretty explosive move in less than 2 weeks to get there. Either way, almost 20,000 contracts going up there as well. The big day was Tuesday, about 7,000. Looks like folks mostly bailing then, so maybe a lot of this is overriding, folks getting the hell out of Dodge on some of this this upside here in nat gas. 5,600 on Monday, opening there, 3,500 on Wednesday, and I've got 3,500 again today. Again, that's against OI of nearly 21,000. So there is some size OI on that strike. Worth noting, the call skew out here this week did get more bid. As we said, it went from 2.2% bid to nearly 6%. So some of this could be folks scooping the 3s. I don't know if I love buying the 3s here. And I'm sure if Carly was here, she would say the same thing. The 3s in 12 days? I don't know. That could be a bit of a bridge too far. Even 2.5 at this point could be a bit of a bridge too far. But 3s, man, that's optimistic. Again, we are heading into winter. The teeth, really, of winter. So we all know nat gas, a very strong seasonality with this product. So it could maybe conceivably catch a bid then. But I don't know, you listeners, you like that? You like the 3s in 12 days in nat gas? I don't know. I might take a little bit more of a dismissive look at those. But if that's not optimistic enough for you, listeners, how about the 3.5s? Here we go. Those went up 17,000 times this week as well. A lot of paper there. The big day was Monday, 10,300 on Monday. Man, banger day, mostly opening. Paper doesn't line up, so it doesn't seem like it was a roll from the 3 to the 3.5s. And also, when we're selling off, why are you rolling to the upside? That would be weird. But looks like opening paper all week long on the 3.5s too. So, yeah, strange. Usually you might take that opportunity to roll down to the 3s if you're on the 3.5s. Instead, opening all week long on the 3.5s, 10,000 and change on Monday. 2,800 today, 2,000 on Wednesday, 2,000 on Tuesday as well. So again, opening all week long. The OI coming into today, 31,000 contracts. So no small amount of paper open on these strikes. My goodness. And then right behind it, we have a tie for the 2.5 calls and the 2.25 puts, both doing about 14,500 contracts this week. So intriguing stuff out here. Let's scroll a little bit farther out to see if we can see any other interesting and or aberrant plays. You know, going back to that seasonality, it seems like some folks aren't giving up on that 3 strike. Looks like March 3s going up about 12,500 times this week. I got to admit, I like the March 3s with 74 days to go. A lot better than the Jan 3s with 12 days to go. A little more time for that to pop off out there. They went up about 12,500 times. The big day for those was Wednesday, opening 4,000 times. Actually, no, Monday. 4,700 going up on Monday, also opening. So size opening paper on the 3 strike out here in March. And today's paper, 3,100 against OI of 7,100 out here. So interesting stuff, listeners. 3 calls in March. Does that float your boat? Perhaps a little bit more. By the way, the skew in March, those calls are now 6.3% bids. So again, the skew getting a little bit juicier out here in March. Mr. Rhoads, any of this paper I'm laying down here floats your boat, or anything else catch your eye in the world of nat gas, sir?
Man, it took natural gas, and again, looking at the contract I was looking at, it took it, I don't know, like 16, 17 trading sessions to get from 3 to 2.5. I just can't see it, or down to 2.4. I just cannot see. I would not be buying the 3 calls. How's that? Even if we break the downtrend. And the reason is I don't think you have a whole ton of people piling into the short with the contract going down as it has, partially because of the option activity that we've seen. But if you're buying the 3 calls, what you are expecting is something to come out that squeezes a bunch of people that are short. And I'm not sure they're in the market at this time. You know, we're getting down to the time of the year where a lot of people, if they've had a decent year trading, will start to scale things back a bit. And you know, this move to the downside, this sounds like such terrible trader speak, but it may be more of a lack of buyers versus aggressive shorts. And you know, if you want to have a bunch of people that have short positions, if you're trying to push, if you're hoping a market is going to rally the way that buyers of the 3 calls would hope that natural gas is going to rally.
You do sound like an old school trader. More sellers than buyers, kid. Yeah, that's why it's going down. That's what they used to say to me when I walked on the floor of the sea. But why is it rallying? More buyers than sellers, kid. And you know what? Turns out they were right. Those deeply cynical bastards at the end of the day. Let's keep things in energy for a second, because I know you've got some intriguing stuff up your sleeve out here in the land of crude oil. Let's skip over there really quickly, listeners. Pop out of nat gas. Go into WTI right now. 71.83, so managing to recover a little bit north of the 70 handle right now, closing in on nearly a 72, up about 40 cents or about 0.5% since the Monday session. So not a banger week for WTI, which makes sense. That's why it's not on our movers and shakers list this week, even though, and then volume-wise also not a banger week, 370,000, so kind of light. So nat gas blowing the doors off from a volume perspective. WTI taking a bit of a break out here. In terms of action, interestingly enough, 38% of the paper is going up in the Feb contract that has about 34 days to go. So a little bit longer term paper out here in WTI. Even though if you listen to our show we did last week with Derek Salmon from CME, you know the CME is all about the weeklies now in WTI. That's probably the next frontier for those of you out there who were and have been asking about, hey, we want more 0 days. Where are we going to see the next ones? I'd probably put my money on the weeklies out there in WTI. But that said, not a banger week out here. We got, again, about a 71.83 in that front future. The vol in that Feb contract, the 32 and about a quarter, off about 1.25 points. So roughly half of the vol we're seeing out there in nat gas, but still reasonably elevated compared to a lot of the other asset classes we talk about here on the show. Skew-wise, the puts 6.9% bid. So obviously all the interest, all the concern is us retreating back below that 70 handle this week. Even more so, those puts 7.4% bid. And the calls last week, 4.3% cheap. This week, 6.1% cheap. So again, looks like a nice little tidy equity skew out here in WTI. And the big dog out here this week on a kind of light week volume-wise, it's the 80 calls, 8 zeros. That's interesting. Actually, I take it back. If you go beyond, that's the busiest contract in the March expiration, the Feb expiration cycle. If you go out to March, the 60 puts, which makes a little bit more sense, were actually the number one overall volume contender this week with 16,200 contracts. Over half of that going up today, 8,500 contracts today against an open interest of 15,000. So a lot of paper going up today. 5,000 on Tuesday, mostly opening. 1,500 on Monday, closing at about 1,200 yesterday. Slightly opening there as well. So 60 puts in March. I could see some of that going up. That's a decent long time frame. But the 80 calls, that's kind of interesting. Those are expiring in February. So you got a little bit of oil upside in your back pocket, listeners. Maybe you're betting on a little bit of a retracement here, a little bit of a post-OPEC rally. They do something out there to drive us some upside. Either way, 80 calls in February, lighting it up, taking the number 2 spot this week, 14,000 and change. Tuesday was the big day for those, 7,500, mostly opening there. Today, 3,500, not much to speak of there. And then about 1,500 each Monday and Wednesday, slightly closing there. The OI coming into today, 9,000. Now, Mr. Rhoads, upside in WTI is not the first thing people think of these days when WTI continues to test new lows out there. But it sounds like you've been thinking about some upside. So let's get to that. And also, before we get there, really quickly, what, if anything, is catching your eye out there in WTI? And then what you got in your back pocket for us for a little bit of upside fun?
Well, I looked at skew on the first 3-month WTI, and all of it's all heavier to the downside. So which I find kind of interesting, because usually when we see oil hit some sort of a support level, and I would say that 70 has kind of acted like a support level for a little while here. You start to see the skew switch over to being dominated by the call side versus the put side, and that hasn't quite happened yet. Which I was a bit surprised at. So about this time last year, actually on December 16th of 2022, I was on vol views. And we got a question on vol views, which ended up being a 6-month saga about if you think there's going to be a spike in volatility over the next 6 months, how would you trade it, blah, 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 blah. And went through rolling a bunch of option trades. It lost a little bit of money, didn't get hit too hard as a hedge. The exit strategy was if VIX ever went over 30. It did go over 30, but it was only over 30 for about 17 minutes. So I felt like there wasn't enough time to have gotten out of that trade, so I probably would have still been in it. Got a similar question at, I put on my tweed jacket and get out my pipe, not the pot pipe, but the academic pipe, and, grow a little bit of a beard and go to academic cocktail parties. And I went to an academic cocktail party last Friday, and one of the econ professors was like, all right, Mr. Derivative Expert, and that would be me that he was talking to. He said, if you think, and I think he'd had a couple, if you think oil's going to 90 by August, how do I play that? And my response was, okay. You gave me a price and you gave me a time frame. One of the other things that you want to take into account with commodities in certain markets is what's the path? Does he think that crude's going to spike because things are going to expand in the Middle East in the next couple of months, and there's going to be concern about the prices? Or does he think that the price of oil is going to work its way up as the world has an economic recovery or whatever? And he didn't give me a good answer on that. He said, well, how about either? I'm going to stick with the spike. And one of the reasons I want to stick with the spike is if we do get a quick move up in oil, the term structure will invert. So if I went back and looked at a few times that oil has run up $5 or $10 in a very short period of time, and you do see the curve inverting a bit. So my feeling is if you are worried about a geopolitical event that's going to, or any sort of volatility event in the oil market, you want to put on some sort of option spread, and you want to use the front month futures and front month options. And the front month is January, but those expire, I think, early next week. So here's what we're going to do. I am going to I'm going to verbally commit to a bull put spread plus a long call that you can put on with a credit. And when we get to the Friday before the February contracts expire, which is Friday, January 13th of all days, I'll roll out to March. And I will continue to do so through the August contract and see how this works. The exits, and I'm writing all this up in a blog, so don't be scribbling all these things down. But the exit strategies, if the future hits over 90, we exit, or we continue to roll it. And if we don't get that move to 90 by August, we just stop rolling the trades in mid-August. So I think I explained all that fairly well. I do know there are a lot of moving parts there. Am I being somewhat clear, Mark?
No, I like it. Sounds like we have another fun.
I just want to make sure that I'm not confusing
another
people.
Fun, roughly 6 months of upside trades to dissect with you. This time in WTI.
Exactly.
Sir.
Isn't it fun?
I like it. I look forward to it.
It's great. Well, get me back on here. You should just go ahead and schedule me for January 12th.
There we go. We'll schedule you for
I'm
all the rolling
being
points.
Serious.
I'm starting to see a bit of a pattern with you, too. You like your bullish risk reversals and a little bit of vol and a little bit of WTI, sir. Go figure.
Well, and he was okay with up to 5 points downside in oil, which helped me tremendously. So with let me find where I wrote that. I already wrote the trade down. With the February contract at 71.80, I sold the 70 puts for 202, bought the 65 puts for 77 cents, and that gave me $1.25. I used $1.20 of that to buy the 76 call. So is it, if we're between 70 and 76 and we just meander around, basically it's a scratch trade. If we go to the downside, there is some downside risk. He said he was okay with that. He felt like 70 was a pretty good level that it wouldn't go below. But he did want to limit the downside, and we did talk about buying a future and continuously buying puts against it. But I think this is the better way to go about doing that, because when roll time comes around, there is a darn good chance that we might be able to roll it, for a little bit of credit, maybe. We'll see.
Yeah, I like it. Good luck.
That's where I'm at on this. I'm going to put it up on my Substack probably first thing tomorrow morning, and that's that for that.
If you're just buying a future and buying puts, good luck explaining to that professor when you're a few months into it and all the drag is on that and he's against it with the put. He's going to be coming back to you saying, why did you tell me to do this? So this, I think, is a better way to go about it. And we get this question a lot from our audience, too. What's a good way to get long-term, long crude oil? And it's a challenging thing. You're right, because for a lot of our audience, they're not going to just buy and hold the future, nor is that an appropriate trade for a lot of them to do. They don't want to go out and get long, your typical ETFs like USO and other, for all the reasons we laid out here on the show in the past. They all get killed over time by the roll yield and everything else. So it kind of is a bit of a kind of roll your own, do it yourself type of trade. And this is one way you could go about it, listeners. So if you're intrigued, by this is the question you've had in the past. You think maybe oil's a little bit beat up. Maybe you think it's on the turnaround, or maybe just for future reference, you want a little bit of upside. This could be an intriguing saga to watch play out. So keep an eye on us out here on the show. Keep an eye on Russell, of course, on Twitter. I'm sure he'll be tweeting out his usual updates, and we'll have him on, of course, regularly to give you folks some updates as well. So this is a question you have. How can you get a little bit longer term, some upside in a product like WTI? Might be an intriguing one to investigate. But Mr. Rhoads, it is Fed week. The equity markets have been just whipsawing all over the place. We've got volume for days out there, and just about every product going on out there. We have the once and future Dr. Vix joining us today. So I would be remiss if we didn't talk a little bit of equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the world of equities. Pop out of the energy complex. You're only going to go down one slot to equity indices. It is an alpha order list, after all, listeners. Then you're going to go to U.S. Index E-mini. And from there, it's kind of an embarrassment of riches. Even though I have a feeling we usually hang out in the S&P 500, I got a feeling Mr. Rhoads might want to talk a little bit of Russell 2000 today as well. But Mr. Rhoads, obviously a banger week, as Fed weeks are wont to be. They really came out with, I think, to put it mildly, a dovish tone yesterday, kind of catching even some of the bulls off guard with how dovish they were. Markets rallying hard yesterday, coming into today, they started off getting the bit in their teeth, rallying us well north of 4,700 up to about 47, almost 47.40 before the worm kind of turned. When we were talking about it on the option block not too long ago on the show, we had dipped back below 4,700 again, so the S&P was actually down on the day. Now that we're getting a good way into TWIFO, it seemed like the worm may be turning again. S&P up about 0.25%, close to it again right now, but we are in kind of that tug of war. Yesterday, the bulls firmly had the bit in their teeth. Today, we're getting back to that tug of war we're kind of familiar with between the bears and the bulls out there, which is what makes a market, makes it so fun. But Mr. Rhoads, what were your thoughts out there on what we saw from Powell, from the overall equity market and indeed volatility reaction? Then if you want, we can sink our teeth into your new favorite, the Russell 2000.
It's not my new favorite. I've been stuck with it forever. And it's finally working for me. But, as far as Powell, first off, I just, and even my students do this, and I think they're just parroting what they hear out of the press or what they read on Twitter about how rotten Powell is. He doesn't know what the F he's doing, et cetera. I think he's doing a pretty good job. I feel like if he weren't doing a really good job, would the market have reacted the way that it did? The market, the one thing that I find kind of interesting was we got that shift in the odds of a cut in March. It was as low as 45%. It's up at 75% now. It just completely reversed. After that employment number, there started to be some questions as to whether we would get the first cut in March. And then as Powell spoke, that number reversed. And that's what gave the legs to the equity market rally that we just saw. And I think, the Russell 2000 caught the biggest bid because we're talking about the U.S. economy, and Russell 2000 companies have more exposure to the U.S. economy than S&P 500 companies. They've also, right now, I think we're 25% off of our all-time highs in the rut, and we're right at it in the S&P 500. So seeing a shift where domestically focused companies were starting to catch a bid, that was a reason to get out of the way, regardless of any equity shorts that you had over the last couple of days. Now, maybe it peters out because more and more people are calling it a year, but I feel like he's done a very good job. We never really have any major surprises. We rarely have excessive volatility around FOMC announcements. So, more power to him. They seem to be managing things fairly well. And I just don't understand why everybody picks on the guy.
I will say this. It is a challenging job, obviously.
It is. I don't want it.
To guide the global economy. No mean feat. I've said my piece on Powell in the past. I won't belabor it here. But yeah, you're right. At least right now, they're trying to, shall we say, maybe work back some of the things that they unleashed unwittingly, perhaps, back a few years ago on the economy. But intriguing stuff out there. As you mentioned, kind of quite the rampage. And man, do small caps have the bit in their teeth? My goodness, coming into the start of the show, we're seeing the rut just a tick under 2,000 in that front future, 1997. Of course, that's going the way of the dodo pretty soon. Once that goes away, we are north of 2,000, 2018, up 100 and almost 116 handles, or 6.13% just this week, just since Monday. Of course, if you go back to the end of our show last week, we have the Russell 2000, our number 2 light side mover, up nearly 8%. So, man, quite the banger out there. And if you've been listening to this show for a while, we used to do weekly rundowns on all things Russell 2000. I just never really put up a ton of paper to really be able to parse a ton. Most weeks you see 10, 12,000, maybe 15,000 contracts. A good week, a pretty strong week was 25,000 was, man, this is an explosion of paper. This week, listeners, 56,000 contracts on the tape for the Russell 2000. Again, it's no E-mini S&P, but it's this from a Russell 2000 frame of reference. This is an explosive, historic week yet again, listeners. And what's interesting is that it's not the usual flow that you expect in the E-mini S&P where it's all 0 day, all going away tomorrow. And if you go out 3 or 4 days, fully half of the paper is in that cycle. No, we're going a little bit farther out here for the Russell 2000, which is kind of interesting. In fact, the biggest trade of the week, nearly 3,000, are the end of month February 1800 puts. So going in the other direction, listeners. Remember, next year, a leap year. So these are end of month February 29th. These are leap puts. You can only trade them once every 4 years. Maybe that's why this person's doing it. It's a very, very historic occasion out there. They went up, again, all of that in one day, 2,844, all of that going up this morning, actually. So somebody fallen in love with the 1,800 puts, at least putting up some volume. Now, worth noting, there's 5,100 open on this strike. So they could be bailing on these things. They could be saying, you know what? I had a long of these, or probably if it's an equity, they could have been short these too, and they could have taken their profits off the table. Either way, listeners, end of month leap year, February 1,800 puts, leading the dance out here in small caps. Mr. Rhoads, I'm guessing you didn't have puts on your bingo card in the Russell.
I didn't have leap puts. And I believe we've talked about this before. I had a long Russell short S&P 500 position on since like July. And and the reason was because the Russell had underperformed by about 15%. They've narrowed that spread to 10. But still, they've underperformed 10% this year. One thing I did want to, and I'm not talking my book here, I swear I'm not, but, I like to look at we like to look at skew in a lot of markets, and we tend to ignore it somewhat in the equity markets. But right in the Russell complex is one market where sometimes we see calls bid more than puts. And right now, if you look at the 5% out of the money, just a consistent 5% out of the money 30-day measure, the upside 5% is slightly higher than the downside 5%. So you get this weird FOMO trade in the RUT option market sometimes. And we're seeing that. And this is the first day in 2023 where the call implied volatility has been higher than the put implied volatility. The average is about 80%, that the call's usually at about an 80% discount to the put.
Yeah, you're right. Small caps can get caught up in some of that meme stock FOMO love, and you're right. They're exhibiting that right now. Strong bids in all the near-dated stuff. The contracts going out 4 days, 6 days, 8 days. The calls were 6.5% bid last week, 7.4% bid. 6.2% bid, 13.7% in the calls going out in a day. Obviously, a lot of that upside has now gone away because we have seen it. So folks are taking those calls off. But still, if you go out to 22 days to the Jan contract there, early Jan, there's still a little bit bid out there. So yeah, it depends. But yeah, you're right. That's not a thing you see in the E-mini S&P very often. So if you're looking for some attractive upside, maybe you're an aggressive call overrider, you could do a little worse than a little bit of the old Russell 2000. And you know what, listeners? We can always do worse than your feedback because you folks always bring it. So let's get to it.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Let's get to some of your feedback out here. In fact, Mr. Rhoads, we got a fun one out here. We have a fun question of the week going right now, very much inspired by the debate we've been having on volatility views recently. And I know you're not going to be on the show tomorrow, so I thought it was a perfect time to get your thoughts on this because this is up your alley if anything is up your alley. It's about your favorite product, Mr. Rhoads, which is SVIX. Are you familiar with it, sir?
I've heard of it, but let's go ahead.
All right, let's go. You look it up while I'm talking about it. How about that?
Yeah.
SVIX, of course, listeners, the inverse VIX product. So when VIX goes up, it goes down and vice versa. This has been an interesting one to watch. It usually attempts to generate those returns using VIX futures. Lately, it's incorporated VIX options and surprising all of us, myself included, It wasn't using VIX puts. It was actually using VIX calls. They're holding a whole bunch of VIX calls out there right now, which is both interesting and a little bit alarming at the same time. I still don't know where I fall on this, which is why we put it out to you folks. You folks are the ultimate arbiters at the end of the day. We know a lot of our listeners hardcore into the vol trade. So we thought we'd ask you folks, does SVIX adding VIX options into its holdings, in particular VIX calls, does it make you more or less likely to trade it? It gave you three choices. More likely because you feel it's safer. Remember, this is an inverse product, listeners, and the last product that did this, XIV, infamously blew up back in February of 2018 when VIX exploded and XIV went to zero. So if you're worried about a VIX explosion, having some VIX calls in your back pocket, not the worst thing. Or maybe you're worried it might gum up the works from a tracking perspective, make the product perhaps not as desirable from that point of view. So maybe you think you're less likely because of the tracking, or you don't care because you're still gun shy from the XIV implosion back in 2018, and you're not going anywhere near any more inverse vol products. Mr. Rhoads, you've been thinking about this for a while. Which way do you come down? And then B, which way do you think our audience is going?
Well, I blurted out without really thinking about it on vol views a couple of weeks ago that them holding the calls gives me more confidence. I'm not as worried about some sort of volatility incident or what we had with the Volmageddon and everything. And in fact, what I just scribbled down, I think you get irritated. I know you get irritated with me on this program because sometimes I zone out for a second. And usually when I'm zoning out, it's because I got to write something down that popped in my mind. And the thing that popped in my mind and the work that I'm going to do now that we've got Christmas break at the university, I want to figure out what would have happened to XIV if they were doing the same thing. Oh. If they had held out of the money calls on Volmageddon Day, would that have saved them or not?
Could that have saved them? It would have definitely softened the blow,
would it or not? I was actually trying to find their whole, the holdings that they had on those days. I mean, I know they were short futures, but I was trying to figure out what the split was between, in that case, it would have been the February and the March futures because it was early February, correct?
Yeah.
So I think that's going to be an interesting exercise that I can hopefully get around to just to see if it would have saved them. My feeling is, without any insight from the managers, that this really is a risk control measure. I don't think they necessarily have an opinion or anything, but they're starting to get more assets under management. They're starting to become a bigger part of the open interest in the VIX futures contract. Not a huge part, but still, you don't want to have to worry about liquidity because when you usually worry about liquidity when you need it most. And by purchasing those calls, or by having those calls on, they are able to pretty much, have a hedge and will be assured that the Volmageddon situation will not repeat itself.
Yeah, that is one of the big albatrosses hanging around the neck of this product, right? Can it go the way of the dodo? If you're worried about that, then maybe you're willing to give up a little bit of tracking for the security. Where do you think our audience is falling, Mr. Rhoads?
Oh, I think they're following along with me because I said it on the program and then they just, it's stuck in their minds.
You are driving. Well, you're not wrong right now. 50% exactly right now saying they're more likely to trade it. It is safer. Followed by 30% worried about the tracking. They're less likely to trade it. And 20% are still gun shy after XIV. So our audience, if you look at it in terms of two choices, are exactly evenly split. Half like it because it's safer and half are either don't like it or are still too scared to go back into those waters, which again, there's no right answer on this, listeners. It's more of a case of getting your pulse. If you want to vote, get out there at options. You got about a day left to do it. All right, everybody. That music means we have come to the end of another epic sojourn through the world of futures options. Hope you had a good time listening. Hope you picked up a nugget or two. A lot to look forward to on coming episodes. We talk about maybe some of Russell's VIX upside, what's going on out there in a lot of these products. A whole bunch of fun to come. And Mr. Rhoads, if folks want to check in on that fun, where should they go? What should they do?
Right now, just follow me on Twitter. Everything I do, I put on Twitter. It's at Russell Rhoads, RussellRhoads. If you follow the Option Insider, I haven't had a chance to look at Twitter, now X, but I'll bet you I'm linked to a couple of things that you guys are talking about.
There you go. Check them out for yourselves. Russell Rhoads, 2 S's, 2 L's, Rhoads on Twitter. All one word is the place to go for all of his goodies. And you know where to go to get access to these reports. CMEgroup.com/TWIFO. The place to go to kick the tires and light the fires. They are running 24/7, so you can check them. If you want to check lean hogs at 3 a.m. on Sunday morning, it's there for you. CMEgroup.com/TWIFO is the place to go. We got to get on out of here. That's going to do it for us on the network today. Back again tomorrow to dissect this mad week from a vol perspective on volatility views at noon. After that, for all of our pro folks, you can join us for a little bit of the old options oddities to break down a crazy, unusual activity week. What trades were going up that caught our eye? What trades do we have on? Did they work? Did they not? We'll find all that out tomorrow on Options Oddities. You want to check that out, as well as check out the awesome double pro Q&A sessions we just did for you folks this week. Only one place to go. TheOptionsInsider.com/pro is the place to go to learn more. Then, of course, we're back again on Monday with the Option Block and the Crypto Rundown all the way through to next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.